Three former employees accusing Deutsche Bank of covering up billions of dollars of derivative losses during the financial crisis. Deutsche Bank is denying these allegations. Joining us now on the phone from London is Simon Mon of Olive Tree Securities. Simon, this has been playing out since yesterday when it was first reported by the Financial Times. Much speculation. What do you make of it?
Well, it hasn't come as a huge surprise to any number of financial specialist investors over here in Europe that there were question marks about the quality of Deutsche's capital. The bank was one of the leading players in the originate and distribute model, and basically if you were in that model, you were also in the buyback and trading business, where you ended up owning quite a lot of the securities your origination desk was selling. So it hasn't really come as a surprise that this is involved. What perhaps has come as a surprise, but the event is so old that actually we're now digging this up again. And that's the most interesting thing to me. Where were these whistleblowers in 2008?
Well, we might ask the same question about LIBOR. In this particular case, though, the most important question seems to be whether this was a fraud, call it. Now, I know you don't have access to internal documents. You can't see the paper trail. You can't tell me whether you know that it's a fraud. But based on what you know about Deutsche Bank, based on what you know about people like Anshu Jain, and let's forget about fraud for a moment, do you believe that this bank was extraordinarily aggressive in marking its positions in its own favor and, as these former employees allege, not recognizing losses it should have had they been marked to market, quote-unquote, properly?
Well, two things we should say in Deutsche Bank's defense around. First of all, there was a change in IFRS accounting which allowed you, when liquidity had dropped away, to reclassify what previously had been trading assets and put them on the held-to-maturity book and treat them almost as if they were loans. Now, of course, on the one extreme, you've got Goldman Sachs, who throughout the crisis and beyond has said that's not the way you should do it if you're in the investment banking or securities business. You should be marking to market absolutely everything. But we do know that Deutsche Bank, as and when it suits them, is very happy to be regulated as a commercial bank. It is a major commercial bank in Germany, even though globally it is predominantly an investment bank. And commercial banks have loans held to maturity, and that's how they treat these things. So certainly, that was, you know, they were within their rights to use that accounting policy.
Simon, we also know that throughout the crisis, Anshu Jain has been very focused on becoming the CEO of Deutsche Bank and has been public about saying they had, comparatively speaking, a very strong crisis compared to other banks. Could one say, well, maybe DB was hiding things, marking things too aggressively because Anshu had his eye on the prize, not on what was actually happening in some of his more complicated businesses?
I'm not sure we can really personalize it in that way. If you talk to people in the financial world here in Europe, particularly outside of Europe, then they would say, look, Deutsche Bank is the national champion of Germany. And in that environment, we would expect them to receive favorable treatment from local regulators that perhaps isn't available to absolutely everybody else. And that may mean that they are allowed to be a little bit more aggressive with the number and the quantity of assets they're applying these new accounting rules to. They're allowed to operate with perhaps lower capital ratios than internationally we would like to see, but that's part and parcel of being a national champion. Now, we don't know, and there's no reason that we have to believe there's anything fraudulent or anything that's being driven by Anshu Jain in that. It is just the nature of the fact that Deutsche Bank is Germany's biggest bank.
Great thoughts. Thank you so much, Simon Mon of Olive Tree Securities, for joining us this morning, talking my alma mater, DB.
Stephanie, let's return to our conversation with Philip Weingold of Sear Capital.
Weingold.
Pardon me, Philip.
And I could say that because I should qualify. I used to work for Phil.
There we go.
There you go.
So, Philip, you worked at Deutsche Bank. You left, though, in April of 2008, correct?
Yes. Yep.
Do you recall it being an environment in which this kind of thing happened, where senior executives were involved in conversations about pricing and, you know, if not ordering, you know, talking enthusiastically, let's say, about marking things to a level where they favor the bank?
You know what? It was when you're marking sometimes illiquid assets, there's always a certain amount of latitude one would have. Deutsche Bank always stayed within the guidelines. I would, I'm not too privy to a lot of the details going on
Understood.
right now, but I would always be a little skeptical many years later of a couple of employees coming out and saying something. Seems a little odd to me. But, a bank will always have a little discretion when it comes to illiquid books. And my experiences is, you have two lines in the sand, and Deutsche typically stayed between them.
That seems to me where the burden of proof is going to be toughest, right? The fact that there is discretion. We were talking about it earlier with the chief financial correspondent, Christine Harper. Not only is there discretion and judgment that needs to be applied, but we're talking about securities that were highly leveraged, that were volatile to begin with, and then at that time were extraordinarily illiquid. Would you have had a difficult time pricing them?
You know what? I'm not intimately familiar with the
not with those securities in particular,
about.
but I mean,
look,
was it
always
very difficult in 2008 to price securities like that?
It's specifically in corporate correlation, where they were valued, the reserves held against them.
Sure there is. And you know what? I think the problem with that is many of these securities are not priced to market, but they're priced to models.
Right.
And when you get to pricing an instrument to a model, it then is driven by what parameters you enter into those models for valuation. And then one can question what those parameters were. So I think that is where things get fuzzy, where somebody can say, no, I can't point to where this instrument will actually trade or who would bid it or who would offer it, but based on our analysis, this is what we believe the value. And I think it's very easy to look back years later and say, well, the assumptions that you put into your models may have not been correct, or possibly your models weren't correct. So it's easy to second guess those things, but many times you do have to rely on that type of process.
And we can't take some former disgruntled employees, every bank has them, word for gospel.
That's true.
But in hindsight, when you saw these headlines, being a Deutsche insider, being a Deutsche alumni, are you completely surprised, knowing the complicated products they were involved in, that Deutsche made it through the crisis in the last few years so well and didn't need a bailout? Knowing what you knew, what was in those books, were you surprised?
No, I wasn't surprised that Deutsche didn't need a bailout. Deutsche, in many regards, look, Deutsche was very cutting edge with respect to financial instruments. I think by most standards is probably the top fixed income shop in the world. And, Deutsche had, we had many risk meetings where we were talking about what the hedges were. I think Deutsche managed the process rather prudently, took a couple lumps, but, didn't need to go hat in hand to the government for any money.